The collapse of empires is usually loud, cannons firing, boots marching, shells screaming through the air. But in the 19th century, the largest empire in the Middle East was dismantled almost silently. Not by soldiers, not by invading armies, but by accountants. It wasn't overtaken with gunpowder. It was overtaken with compound interest. This is the story of the very first modern debt trap, and how the Ottoman Empire, a superpower that had terrified Europe for centuries, was slowly strangled by the banks of London and Paris. And this story still matters today, because it exposes a brutal geopolitical truth. You don't need to invade a country to control it. You only need to hold its mortgage. And to understand how this happened, we have to look at the Ottoman Empire at a moment when it still looked like a titan. In the middle of the 19th century, the Ottoman Empire stretched across the Balkans, through Anatolia, over the holy cities of Mecca and Medina, and deep into North Africa. From Istanbul, the Sultan ruled millions of subjects, sitting on a throne that symbolized the intersection of continents and trade routes. On the surface, the empire still looked grand, but beneath that surface, the foundations were cracking. While Britain and France were racing through the Industrial Revolution, building factories, railways, steam engines, and modern armies, the Ottoman economy remained anchored in an older world. It was agrarian, fragmented, and slow. Peasants and artisans struggled to survive while machines transformed Europe. The treasury was almost permanently in deficit. The tax system was inefficient and deeply corrupt. Money leaked through every administrative layer, and by the time revenue reached Istanbul, much of it had already been stolen or wasted. For centuries, Ottoman rulers had survived financial crises using familiar tools, debasing the currency, confiscating wealth, or forcing emergency contributions from elites. But the modern world made those tools obsolete. The empire needed a modern army to defend itself against Russia. It needed railways, roads, and telegraphs to survive in a European-dominated system. And all of that required something it increasingly lacked: cash. For a long time, Ottoman sultans resisted borrowing from the West. Usury carried religious stigma, and political dependence on Christian powers was feared. But history rarely waits for principles. In 1853, Russia invaded Ottoman territory. The Crimean War erupted, and the Ottomans could not fight it alone. Britain and France intervened, not only with fleets and soldiers, but quietly, with bankers. The war consumed the treasury at a terrifying pace. Soldiers needed salaries, weapons needed factories, ships needed coal, and none of it could be bought without money. Sultan Abdülmecid I faced a brutal choice: break an ancient taboo or lose the war. In 1854, the Ottoman Empire took out its first foreign loan. It was described as friendly assistance. In reality, it was the first link in a chain. The conditions were punishing. For every £100 the empire agreed to repay, it received only around £80 in cash. The rest vanished into commissions, fees, and risk premiums, yet interest was charged on the full amount. This was the first critical mistake of Ottoman finance. They borrowed expensively, received little, and still owed everything. Still, when the money arrived in Istanbul, it felt miraculous. The army was paid. The immediate crisis eased, Russia was defeated, and a dangerous lesson was learned. With a signature in London or Paris, gold could be summoned. The war ended in 1856, the borrowing did not. Ottoman elites traveled to Paris and London. They saw boulevards, opera houses, industrial power, and financial confidence. Compared to that, their own cities felt inadequate. They wanted Istanbul to look modern. They wanted to prove that they were not the sick man of Europe, so they began to spend. But they did not spend on factories, irrigation, or education, investments that could generate future revenue. They spent on prestige. Nothing symbolized this better than Dolmabahce Palace. Sultan Abdülmecid decided that Topkapi Palace was outdated, too old, too Eastern. He wanted a palace that could stand beside Versailles. Dolmabahce was built with gold leaf, Italian marble, crystal chandeliers, silk carpets, and imported luxury. It was breathtaking, and it was built on debt. Its cost approached a quarter of the empire's annual tax revenue. While peasants in Anatolia struggled with wooden plows, borrowed money, paid for crystal and gold, loans multiplied. 1855, 1858, 1860, and beyond. Bankers in London and Paris were eager to lend. Interest rates were high. Commissions were generous, and everyone assumed the great powers would never allow the Ottoman Empire to fail because it was strategically indispensable. That assumption has a name: moral hazard. By the 1860s, Ottoman finances had become a treadmill. The empire could not generate enough revenue to pay interest on existing loans, so it borrowed again to service the old ones. A hole filled by digging another hole. By 1870, more than half of state revenue was consumed by debt service. Think about that. Half of every coin collected from a fisherman in Greece or a farmer in Syria flowed overseas to bondholders in London and Paris. That meant less money for the army, less money for roads, less money for schools. The empire was being hollowed out from within. Before European loans could keep the system alive, the treasury turned to the Galata bankers, local financiers in Istanbul, mostly Greek and Armenian families. They provided emergency cash at brutal rates, 18%, 20%, sometimes more. Short-term survival, long-term ruin. At the same time, Sultan Abdulaziz pursued another expensive dream, a modern navy. Ironclads were built in British shipyards. Modern artillery was imported. On paper, the Ottoman Navy became one of the largest in the world. In reality, it could not be maintained. There was no money for coal, no money for repairs, the ships rusted in harbor. They became floating piles of debt. Then the world turned. In 1873, a financial panic erupted in Vienna and spread globally. Credit tightened, capital disappeared, European banks stopped lending. The music stopped. At the same time, nature turned against the empire. Drought struck Anatolia, crops failed, livestock died, famine spread, the tax base collapsed. Revenue fell, debt payments did not. By 1875, the government faced its final choice: starve its people to pay creditors or stop paying and face the consequences. On October 6, 1875, the Decree of Ramadan was issued. Diplomatically, it was a moratorium. Financially, it was default. The Ottoman Empire was bankrupt. This is the moment most people miss. The empire did not collapse first. It defaulted first. European investors reacted with fury. Newspapers screamed betrayal. Political support evaporated, and financial weakness invited aggression. In 1877, Russia declared war. Despite fierce resistance, the Ottomans were exhausted and undersupplied. Russian forces advanced to the gates of Istanbul. The peace that followed was humiliating. Territory was lost. War indemnities were imposed. The empire now owed money to British and French creditors it had already defaulted on, and a new debt to Russia. The burden was fatal. When Sultan Abdulhamid II inherited the throne, the empire still existed on maps. Economically, it was cornered. Europe could have dismembered the empire territorially. Instead, it chose something cheaper and far more effective: financial conquest. In 1881, representatives of European creditors arrived in Istanbul. Not generals, bankers. They demanded no land, they demanded revenue. The Ottoman Public Debt Administration was created, an institution under foreign control that directly seized the empire's income streams: tobacco, salt, silk, fishing, alcohol, stamped paper. Thousands of collectors answered not to the Sultan, but to creditors. The empire still existed, but sovereignty was gone. The OPDA was efficient. Revenue stabilized. Some industries improved, but all of it served one purpose: paying foreign bondholders. The state remained permanently poor, unable to modernize on its own terms. The Sultan ruled from his palace, but not over his finances. If he wanted to build a road, fund a school, or reform the army, he first had to ask whether any surplus remained after debt payments. Usually, there was none. Germany later entered the picture, offering railways and partnership instead of pure extraction. The Berlin-Baghdad Railway promised development, but came with its own strings. One set of handcuffs was replaced with another. By 1914, war looked like an escape. It was a gamble, and it failed. The empire collapsed. But the debt survived. When Mustafa Kemal Ataturk founded the Turkish Republic in 1923, creditors returned. Their logic was simple: you inherited the land, you inherit the liabilities. Ataturk negotiated. Payments were reduced, conditions eased, but the debt endured. The last Ottoman debt payment was made in 1954, exactly 100 years after the first foreign loan. The lesson is clear. Debt is not neutral. Every loan is a tether, every bond is leverage, and compound interest is patient. Britain and France never had to conquer Istanbul with soldiers. They let the ledger do the work. The sick man of Europe was not dying of natural causes. He was losing his property rights. Sovereignty is not only flags and borders. Sovereignty is solvency. If you don't manage your debt, it will eventually manage you. Chrono Finance, following the money through time.